Good evening, everyone. Thank you so much for joining. Please just give us 5 more minutes just to let other people who have registered to join the meeting, then we will proceed.
Hey, I think we can start if that's good with everybody.
100%, Tando. You can go ahead. Thank you very much.
Perfect. Okay, so good evening, everyone, and welcome to the JCCI Youth Commission Access to Finance series. My name is Tando Mangisa, and I proudly serve within the events portfolio for the JCCI Youth Commission. It is truly an honor to host this evening session and to welcome each and every one of you joining us today. For those that literally are new or maybe joining us for the first time, the Johannesburg Chamber of Commerce and Industry, through the JCCI Youth Commission, is committed in empowering young professionals, entrepreneurs, innovators, future leaders, and that happens all through collaboration, development, networking, and most importantly, access. The purpose of the JCCI Youth Commission is really to create meaningful platforms that encourage growth, leadership, business sustainability, access to opportunity for young people, especially those that are navigating through today's economic landscape. So if you're one of those, I think you're going to really enjoy today's series. And we are passionate about building enterprises, driving innovation, and contributing towards meaningful, impactful economic participation. Tonight's webinar forms part of possibly one of the most important conversations around access to finance for SMEs, a challenge that continues to impact many entrepreneurs and growing businesses. So through this webinar series, we aim to literally provide practical insights, real-world solutions, valuable industry knowledge that can possibly help businesses become funding ready and financially sustainable. This session also marks possibly one of the first of four-part webinar series titled Access to Finance for SMEs, where we unpack critical topics affecting entrepreneurs, including understanding the financial landscape and mastering purchase, as well as contract financing, becoming funding ready, and exploring strategic financial growth opportunities. So before we continue, one of my favorite parts of today is acknowledging my incredible team and everyone behind today's event and the work that we continue to do with the JCCI Youth Commission. Firstly, our lovely and beautiful chairlady, Ms. Nonjabulo, whose leadership and direction continue to guide vision of the commission and excellence and purpose. We've got our amazing Sino Tando, who leads our marketing and communications portfolio with creativity, consistency, and as well as strong brand presence. Our beautiful Noktula, who oversees governance and obviously administration of affairs with professionalism, structure, and grace. Mr. Wade Williams himself, who manages our stakeholder engagement, who continues to build valuable strategic relationships for the commission. And finally, a true force within the team, our membership portfolio manager, a leader that is passionate about people, connection, and of course, community building, the legend himself, according to me, Mr. Zweletu Dlamini. And of course, without me boring you further, it is now my pleasure to hand over to Zweletu, who takes you over to the proper understanding of why we are here today. So Zweli, over to you.
Thank you very much, Tando, for that amazing introduction to the team and to everyone. It's such a pleasure to hear from you and to be hosted by you this evening. Welcome everyone to this Access to Finance series webinar. My name is Zweletu Dlamini. I serve as the Membership Portfolio Manager for the JCCI Youth Commission. It's an honor to have you all with us today and an honor to also have the privilege of introducing our guest speaker and presenter for the evening. We have reached out to one of the youngest, most dynamic, strongest leaders within the finance sector in South Africa. He's a young man who founded his own firm that provides financing within the local environment and across Africa as well. So we invited him to come and speak because we were looking forward to having someone who is in the environment, who is in the marketplace, who is funding businesses, not just youth-owned ones, but large corporates across the African continent and within South Africa. It's my pleasure to introduce Mr. Prince Moeng. Mr. Prince Moeng has a strong and dynamic background. He is the managing director of Two Cents Solutions, which is a funder based in Johannesburg, South Africa. It's a funder, private credit firm, and investment alternative entity that provides dynamic funding through its investment holding firms specializing in debt, private equity, and investments. It's also a registered credit provider with the National Credit Regulator. It's committed to fostering sustainable economic growth across the African continent through entrepreneurship, as well as funding and lending. The core offerings of the firm are transactional advisory, business development, private credit, and equity support across the various funds that the firm holds. Mr. Prince himself has a dynamic and amazing background in business and entrepreneurship. Firstly, completing his degree in accounting at the University of Johannesburg, where he also served as the ambassador chairperson. From there, going on to complete a financial modeling and valuation analyst certification, as well as becoming an RE1 and RE5 certificate holder, giving him the license and the rights to manage an FSP firm. From there, he has opened and managed a dynamic amount of businesses within the landscape across entertainment and as well as eateries. Mr. Prince was a partner at TDK Design Studios. He was also a fixed asset analyst at Shout It Out Now. He then also opened his own winery business, which is called Moeng Winery, which was based in Johannesburg as well. He then opened a restaurant and managed that, Moeng South Africa, a restaurant that he owned and managed, and then also was a chief executive of African Royal Investments. He further to that went on to then found 2 Cent Solutions, which is his firm and company, which then provides the funding solutions that we're here to discuss today. So he's not only a funder, he's an entrepreneur who has worked in a dynamic amount of industries, from entertainment to finance to business. Therefore, we are pleased and excited to have him today to do this presentation, to speak to us. We would like to open the floor to all of you to ask questions throughout the series. So please, in the chat, post your questions, write them down as he's presenting, as we're speaking, as we're discussing, so that later on towards the end we can have a Q&A where you get to then also ask questions and we get to drive some more of the conversation. Remember that this platform is built to benefit you as a young business owner, as a person who's an entrepreneur. We want you to be able to ask the questions, to learn, to engage as much as possible. We will be hosting other events in this series as well, and we're excited to have you as part of them. Thank you very much. I'll now hand over to our speaker, Mr. Prince. Thank you so much.
Thank you, Mr. Domini. Yeah, for such an introduction. I think we should have just sat down and redid the presentation together, because you've literally taken almost everything that I was gonna say. Let me start off by sharing my screen. Please advise if you can see my screen. Can you see my screen? Everybody's happy with my screen. Okay, I'm seeing thumbs up, so I'm assuming you see access to finance. I need to keep sliding back and forth. Excuse me. Okay. Good evening, ladies and gentlemen. Thank you very much to the team at JCCI for inviting me to come and speak. I work closely with Zweli, so I'm very honored to get the invite from such an esteemed institution, and I hope I do justice today. But let me start with a number that should trouble every one of us in this webinar today. 5.2 trillion United dollars. That is the size of global SME finance gap every single year. Not across history, not over a decade. Every year, 5.2 trillion US dollars of capital that SMEs need to hire, to grow, to expand simply does not reach them. And here at home in South Africa, we carry a 350 billion slice of this gap. An economy where SMEs employ 13.4 million people, where the township economy alone is valued at 900 billion, where 47% of national employment lives inside small businesses that largely cannot access formal finance. Capital is not absent, it is misaligned. Our task today is to close that gap, starting with how we structure the ask. Today's webinar is not theory, it's a practitioner's toolkit. By the time we finish this evening, you will leave with a framework to diagnose your capital needs, match them to the right instrument, structure a compelling finance proposal, and manage that capital responsibly once it lands. Now, let's begin. But before we go further, allow me to introduce myself and the organization behind this webinar, because this is not theory derived from a distance. Everything you will hear today is drawn from our practice. My name is Prince Moeng. I'm the Managing Director of 2 Cent Solutions. As Zweli has outlined, I've studied BCom accounting from the University of Johannesburg and did my investment management from the University of Cape Town. I've also hold an RE1 and RE5 and a class of business in investments. I started my wine company at the age of 21, I think when I was completing university, and we distributed over 10 locations across the country. And then we further opened up a restaurant called Me in South Africa when I was at the age of 25. I've been thoroughly involved in the spearheading and community alignment of funding initiatives through our South African townships with organizations such as the South African Barber Shop and Tax Shop Association and various institutional insurance companies to ensure access to financing for our SMEs. But qualifications are just paper. So what shapes my perspective is the work, the years we spend in the trenches of SME finance, watching capable entrepreneurs be turned away, not because their businesses were unworthy, but because the system was not designed for them. Now, I'm currently the managing director of 2 Cent Solutions, and 2 Cents exists because the gap between capital and businesses that need it is not a market failure. It is a design failure, and designs failures can be fixed. Now, 2 Cent Solutions is a alternative investment firm. We manage private debt and private equity instruments with a single clear mandate to drive inclusive economic transformation and unlock capital for underserved and informal markets across Southern Africa and Africa at large. We are a registered credit provider and an accountable institution with the Financial Intelligence Center. And over the years, we have built a proven track record of developing and deploying sector specific funding mechanisms that directly address structural barriers to finance and catalyze growth for township and rural enterprises. Our philosophy is that commercial return and developmental impact can and should coexist. 2 Cents operates across 4 integrated service lines, each designed to address a different dimension of the access to finance challenge. Private credit, where we use alternative credit assessments tools that look beyond balance sheets to real business performance. We have our private equity and structured investment line, which takes on a hands-on approach, not just writing checks, but working alongside management to build governance, systems, and scale the enterprises. We have our transactional advisory division, which structures support for businesses preparing to raise capital. We help SMEs build investor-ready proposals, navigate due diligence, and negotiate term sheets. That skills that ideally throughout this webinar we'll also achieve. And lastly, we have our business development and support division, which looks at the post-investment capacity building mechanism, because capital alone does not build businesses. We provide integrated support across financial management, operational systems, and market access. With what distinguishes 2 Cents from generalistic lenders is our sector specificity. We do not deploy a one-size-fits-all finance approach. We build programs engineered for the structural realities of each industry. We have our township retail finance scheme, which is over 120 million AUM, financing 4 township-based retails through supplier networks using inventory data, point of sales systems as alternative credit evidence. We have access to over 10,000 township retail SMEs through our origination partnerships. Our second flagship fund is our automotive SME credit fund, which also has over 120 million AUM which is a dedicated credit facility for the automotive supply chain, including fitment centers, parts suppliers, and service providers. We've integrated this solution through the RT46 government contract, which initially was managed by West Bank and is currently managed by AfriRent. which gives us direct access to over 6,500 automotive SMEs across South Africa. We have our working capital finance scheme, which as of this year has over about 2.7 billion access deals that we've looked into, which focuses more on a short-term revolving working capital facility for businesses with with strong receivables but constrained bank relationships. We focus more on fast deployment, alternative underwriting, and flexible repayment structures. Our fourth fund is our Green Economy and Agri-Food Fund, with partnership with Oribi, where we focus on early stage capital for businesses operating within the renewable energy space, sustainable agriculture, and agri-food processing, sectors that we believe are critical to South Africa's long-term economic resilience. And lastly, our latest fund, which is our Youth Multimedia Fund, which is a dedicated vehicle to supporting youth-led films, TV, animation, and gaming projects with a strong transformation and cultural impact focus. These programs are not products off the shelf. They are models built from deep sector engagements, understanding the specific barriers and the specific cash flow patterns that the specific risk that characterize each industry. That specificity is our competitive advantage. Our model is replicable by region, by sector, and we have technology that enables us to underwrite consistency and performance monitoring across all our programs. Our ecosystem of industry body partners, including the African Panel Beaters and Motor Mechanics Association, the South African Spaza Shop and Tuck Shop Association, NORIBI, and key value chain partners. This gives our origination reach that no financial institution network can match. This is who we are, and this is why we believe that we have a 2 cents worth of sharing on this conversation around access to finance. Now, before we discuss solutions, we must understand the problem with precision, because one of the most dangerous things an entrepreneur can do is misdiagnose why they cannot access finance. Now, South Africa has approximately about 3 million SMEs. Of that 3 million, 1 million of those operate formally, implying that these are SMEs that have a CIPC number and are registered and have some form of banking account with them. Of these former SMEs, about 85% of these actively seek funding, and only 28% are approved, meaning just 8% of the entire SME population in South Africa receives formal financing. This leaves about 92% of South African SMEs completely excluded from the formal financing system. The problem is not that capital does not exist. Globally, we know that private equity firms, development finance institutions, commercial banks, and alternative lenders collectively manage trillions in investable assets. The problem is structural. Capital is not aligned to how small businesses actually operate. Now, let's consider this. 40% of SMEs worldwide are underfinanced or completely excluded from formal credit markets. And about 70% of all private jobs globally are created by small and medium enterprises. Yet, we've got SMEs which receive a higher rejection rate, about 3x, compared to large corporates when applying for credit. And the barriers are well documented, which is lack of collateral, limited financial records, informal operations, risk-averse banking models, and high cost of traditional finance. These are not individual failures. They are systematic design flaws, and they are exactly what this webinar equips you to navigate. Now, how many of you within the room have been rejected or turned down for financing in the past 24 months? I'll give you a second to raise your hands. I can't see the comments. But how many of you who've tried to apply for financing, raise your hand or put it in the comments, have been rejected in the past 24 months? Now, if your hand went up. You are not alone. You are not the problem. The system is. Now, one of the most common and most costly mistake I see entrepreneurs make in approaching a funder without clarity, one of the mistakes entrepreneurs make approaching a funder without clarity on exactly what they need, why they need it, and when. The first question any serious financier will ask is not, what is your revenue? It is, what stage is your business at, and what will this capital actually do? This is a fundamental law in finance. Your growth stage determines your instrument. A seed stage business should not be approaching commercial banks for a term loan. A mature, cash flow positive business is unlikely to benefit from angel funding. Mismatching stage to instrument wastes time, destroys credibility, and usually closes doors. So let's map this up. There's about 5 broad stages through which businesses evolve. We've got the first stage being seed, which is where you validate your idea. You are testing out a concept, and usually through this stage, the kind of instruments available include your grants, bootstrapping, or angel investments. And then you move on to early stage, where you've gained a little bit of traction, you have some customers, but you need to scale. Now, financing instruments within the space usually are linked to revenue-based finance, seed venture capital, and angel rounds usually would apply at this stage. Then the third stage would be growth, where you've grown from an early stage with traction and you've been able to scale. Revenue is recurring, and the idea around the instruments that you are seeking here usually lie behind a Series A or B, bank debt, venture capital, become accessible. Then fourth stage is the expansion stage, where you are expanding your operations either geographically or through product expansion. Instruments in this for consideration would be private equity, mezzanine finance, or DFI lending, and syndicated loans become relevant. And the last stage being the matured stage is when you optimize your operations. You are managing a large, stable business. Usually, avenues for financing through this would include your public markets, and corporate bonds become your tools. They usually say in finance that you must know which stage you are for you to be able to then name your price. Now, alongside stage mapping, you need a finance readiness checklist. Funders, whether it's going to be debt or equity, will expect a minimum of at least 2 to 3 year financial statements, a clear business model with revenue projections, a defined use of funds with deployment timelines, a strong a strong management team with a demonstrated track record, some form of collateral or asset valuations, and a functioning corporate governance structure. Now, if you cannot tick any of these boxes for now, ideally by the end of this session, you should be able to then at least have a little bit of a guidance in terms of how do you then start prioritizing some of these um, um, tools. Now, these 3 instruments of financing that any SME or business has access to, which is your debt instruments, your equity and hybrid instruments, and then blended finance and DFIs. Now, we're going to start off with, we're going to start talking first with debt first, because debt used correctly is the most efficient way to fund growth without surrendering equity. The fundamental advantage of debt finance is this: you keep your ownership, you pay a defined cost over a defined period, and when the loan is repaid, the relationship ends. No dilution, no board seats, no exit obligation. But, and this is critical, debt requires cash flow. Every rand you borrow comes with a repayment obligation. If your business does not generate sufficient cash flow to service debt, debt will not save you. It will accelerate your decline. So the instruments available under debt instruments include instruments like a term loan, which typically is between 3 to 7 years, and It's best used for capital expenditures, equipment, and operational expansions. We have revolving credit facilities, which are a flexible drawdown structure, ideally for working capital. They are typically between 1 to 3 years. And then we've got trade finance, which is specifically designed for trade or import and export businesses. Would it include things like letters of credit, invoice financing against shipping or shipping documents, and it's self-liquidating and often low cost than conventional loans. Then we have asset finance. The assets itself secures the loan used can be used for things like equipment, vehicles, and machinery, and it's usually between 3 to about 10-year tenor. And then we've got invoice financing, which unlocks cash tied up in your debtor's book. You receive typically about 70 to 85% of the invoice value immediately, with the balance being paid on settlement, which helps with a quick liquidity without having you acquire new debt. And then lastly, we've got corporate bonds, which usually are for large businesses issuing bonds into the capital markets, allowing significant fundraising at a transparent cost without bank intermediation. The key discipline here is matching your instrument to is matching your instrument to your cash flow profile. Long-term debt for long-term assets, short-term facilities for short-term working capital needs. A mismatched debt structure is one of the leading causes of SMEs financial distress. Now, we move on to our equity and hybrid instrument. Now, not every single business should be funded primarily with debt. High growth, capital intensive businesses with long payback periods often cannot service debt in their early years. For those businesses, equity and hybrid instruments are not just appropriate, they are essential. Equity finance means selling a share of your business in exchange for capital. The investor does not receive a fixed repayment. Instead, they share in your upside through dividends and ultimately an exit. The honest conversation about equity is this: dilution is real, dilution is permanent, and when you sell 25% of your business to a venture capitalist, you will always own 25% less. The question is not whether dilution is good or bad. The question is whether the capital, the expertise, and the network that comes with the investor is worth more than the ownership you surrendered. For the right business at the right stage with the right investor, the answer is unequivocally yes. Now, within the equity and hybrid instrument structure, there is instruments such as venture capital, which focuses mainly on early to growth stage businesses with strong scalability. Usually, you are looking at ticket sizes between 500,000 rands to over 10 million rands, and dilution can typically look like a 15 to 35% dilution ratio. Then we've got private equity, which focuses on growth to mature stage businesses, which captures larger ticket sizes, anything above 5 million rand and usually to about 100 to even more than 100 million rand and beyond. PE or private equity firms usually take larger stakes and typically drive operational improvements and governance reform. They usually focus on an exit in about 4 to about a 7 year time period. And then we've got mezzanine finance, which is a hybrid of debt and equity, where you receive a loan that carries a higher interest rate than senior debt with equity warrants attached. The warrants give you, the lender, a small equity upside without full dilution. This is ideal for expansion stage businesses and businesses that want to limit dilution. Then lastly, underneath equity and hybrid instruments, we've got convertible loans, which is a bridge instrument. Usually the investor lends you money, and if you qualify equity rounds and it's not raised within a defined period, the loan converts to equity. This is usually used for seed and early stage rounds where valuations are difficult to establish. But I must remind you, equity is not free money. It is the most expensive money you will ever raise because you are paying with a percentage of everything you build from this day forward. Then, lastly, blended finance and DFIs. This is a category that many SMEs, especially those in underserved markets, completely overlook, and that is development finance. Development finance institutions, which is DFIs, exist precisely because commercial markets alone will not finance the businesses and sectors that Africa most needs. They carry a mandate to develop patient, concessionary capital into high impact and high need segments of the economy. Institutions like the International Finance Corporation, the African Development Bank, and the British International Investment collectively deploy hundreds of billions into emerging market SMEs. They often do so below market rates with long tenures and more flexible covenant structures than commercial lenders. Blended finance takes this further. It combines concessional DFI capital with commercial capital to make deals viable that neither could do alone. The DFI takes the first loss position, absorbing initial losses which de-risk the transaction significantly for commercial lenders to participate. The tools underneath blended finance and DFIs include concessional loans, which are below rate lending from DFIs, often with a technical assistance attached, where we have first loss guarantees. The DFIs guarantee first tranches of losses, encouraging commercial lenders to extend credit to high-risk SMEs. We have technical assistance grants, which are non-repayment funding for business development, financial systems, or sector-specific capacity building. And then lastly, we've got risk insurance, which covers political risk, currency risk, and credit risk coverages, typically underwritten by multilateral institutions. If you operate in agriculture, the green economy, township retail, or any sector with a strong development mandate, I would encourage you to actively pursue DFI relationships. The cost of capital is often significantly low, and the value add beyond the capital is substantial. Now, let's talk about how now we understand the business stage that we're in, and we've mapped out the kind of instrument we think we should be using. Now we need to put all of that in front of a funder, and we need to know how do we ensure that they're able to say yes. So a compelling finance proposal is not a business plan. It is not a pitch deck. It is a structured, evidence-based argument that answers one question from the funder's perspective. Is this the best use of my capital, and will I get it back with adequate return? A strong proposal has 6 components. Executive summary, which covers your vision, your ask, your use of funds. The business overview, which covers your model, your market. Financial performance, which should cover any form of historical data, key performance indicators, because numbers tell a story that words cannot. Your growth strategy, which should ideally show what are the milestones to be achieved, shows where the business is going, not just where it has been. Your growth, your funding structure, which is the specific instrument, the amount, how long, if there's security to be offered, and the proposed covenant structure. And lastly, risk and mitigation, which identify key risks in your business and show how you manage them. Do not hide risk. Every funder that I've ever worked with knows risk exists. The question is whether you understand yours. Now, my philosophy is that the entrepreneur who walks in prepared with a term sheet in mind controls the negotiations. The one who walks in and is asking what is available controls nothing. Before we move on, let's spend a little bit of time looking into what are some of the key metrics that funders look at, whether it's debt or equity. And one, you do not need to be a financial accountant, but you must know some of these numbers head on. The sixth that I point out is your EBITDA, which covers what your earnings before interest, tax depreciation, and amortization as a percentage to revenue. This is a core profitability signal. Lenders use this ideally as the basis for debt multiples, right? Your debt to EBITDA, which is your total debt divided by EBITDA, which shows your leveraging ratio. Lenders like ourselves usually want this below 3 times for growth stage businesses, but it's not necessarily a huge common covenant trigger. Then your debt service coverage ratio, which looks into whether the business will be able to repay its debt. And usually we want to be able to see that sitting at about a 1.2, 1.5, usually depends on industries as well. And then your current ratio, which is your current assets divided by your current liabilities, shows your liquidity buffer. Usually 1 is a good number, but 1.5 to 1 is great, primarily because it shows that should anything happen, you have enough assets to fundamentally cover your debt. And then your revenue, your compound annual growth, which for people that will go to VCs, the expectation is to typically keep it above 20% per annum. And for debt, for as long as there's a consistent growth number, we don't really worry much about what that figure will be. And then your gross margin usually is then your revenue minus your cost of goods sold as a percentage. The scalability, this is a scalability indicator. So a 60% gross profit margin business can absorb growth costs for far more efficiently than a business that is doing 20% margin. And then lastly, your burn rate. So for businesses that are going to be going to angel investors and VCs and you are pre-revenue, funders want to see at least 18 months of operational runway. Anything less than that is a high risk. Now, know these numbers, rehearse them, and if any of them are weak, acknowledge it and explain your plan to strengthen them. Hiding the weakness is the fastest way to lose an investor's trust. Now, before I close, I want to spend a little bit of time on what not to do, because the path to finance is littered with avoidable failures. There's about 6 pitfalls that most SMEs find themselves in when they're raising capital. One is undercapitalization. Always model 3 scenarios when you raise capital and raise 20 to 30% more than your minimum requirement. Running out of money after 6 months of raising capital is avoidable using the wrong instrument. Debt before you have stable cash flow is existential risk. Do not let your short-term urgency drive you into the wrong instrument. Ignoring the total cost of capital. Interest rate is not the cost. The true cost includes arrangement fees, legal costs, covenant restrictions, warrant dilutions, and the opportunity cost of management time. Calculate all of these costs before signing. Then 4 is weak financial governance. If you cannot produce clean monthly accounts, you're not ready to take institutional capital. Fix your governance before you approach funders, not after. Premature equity dilution. If you can, exhaust debt and grant option first. Every percent of equity surrendered before you are generating strong returns is a percentage you'll always regret, because you will not be able to use that equity to fundamentally raise additional debt or additional equity in the future. And then covenant blindness. Before you sign a loan agreement, model your financials under a stress scenario. Check whether you would breach covenants, negotiate covenants headroom. The time to negotiate also is before you sign, not when you are in breach. Now, capital is a tool. The entrepreneur who masters its deployment masters their destiny. South Africa has 3 million SMEs. Only a fraction of them will ever access the capital their potential deserves. The reason is really the quality of the idea or the character of the entrepreneur. The reason is always the quality of the preparation. Be prepared, be disciplined, be persistent, and remember, The gap in this market is not a barrier, it is your opportunity. Thank you very much. Questions? Stop sharing.
Wow, Prince, that was really amazing. Thank you so much for that presentation. I think you highlighted quite a lot of critical issues that were quite important, and we have to expand on them. I'd like to open the floor to some questions. If you do have a question, please raise your hand or put it in the
We
chat.
did have one hand, Mr. Dlamini. I think it was Bethany, if I read correctly, if she's still on the call. Not sure if she's still on the call.
Hi, Bethany, your hand is up. Okay.
Okay, we might have missed, yeah, we might have missed Bethany. Oh, she is typing, Bethany B, she is typing. So maybe it's a connection problem, but maybe while she's typing, if there's anyone else.
Okay, I think I'm just going to ask a question in the interim while we wait for Bethany's question. Um, Prince, I would first want you to just please walk through the components of a term sheet. Explain what a term sheet is for those who perhaps don't know what that is.
Thank you very much, Zweli. So a term sheet ideally covers initial commercial agreements or figures that you are intending on entering with a funder. So you have a transaction, you are seeking 100 million rands. What a term sheet does is that it says you are looking for 100 million rand. With that 100 million rand, 100 million has to be in either in debt or in equity. You are anticipating some cost to that. So you are then saying, I'm happy to take on 100 million rand at 18% on a monthly basis repayment. That kind of then governs where you think your business is performing, and it becomes a basis of negotiation to then say, we think on 100 million rand, we can give you that funding at 18% over 2 years. And these are the additional costs that are going to come in. This is the security that we are putting in as a consideration. Here is the reporting obligations that have to be accounted for. And it also outlines the entities and the people that fundamentally are authorized to sign on behalf of the entity. So usually what that does is that you then say, I'm planning on using 100 million rand to purchase XYZ. And that then is then used to then create a master loan agreement or a master funding agreement that then governs the broader relationship. But it gives you a skeleton of what you should ideally anticipate and what you should prepare once you've been approved for funding going forward.
Okay, thank you very much for that response. And then I think my next question would be, you founded two businesses, your restaurant business and your wine business. So you have experience as an entrepreneur. What would you do differently if you were starting a business again that you think entrepreneurs should be mindful of in case they want funding?
I think what I would do differently would probably be setting up structures from the get go. I think a lot of entrepreneurs, because of lack of resources, essentially start their businesses, but they don't have structures. So you know that you are running for instance, with 2 Cent Solutions, we are running an investment firm. Part of our main requirements is having governance structures, right? And what we did early on was essentially to sit back and say, who are some of the critical players or who some of our mentors that are in the space that we can rope into our business and ideally ask them to sit on some of our boards so that we are able to then have some form of governance structure, right? we started employing systems in place. So we knew that if a business applies for funding from us, there has to be a process that we follow, and that process has to be the same on Monday, on Tuesday, Wednesday, or Thursday, and has to be documented because our credit policy has to be tested for scalability, because I can't decide that I want to finance one deal at a certain percentage and then tomorrow a similar deal at another percentage without fundamentally outlining what some of those differences are. So, what assists businesses get funding ideally is on the structure, because we are looking at how the business is performing as one element, but we're still making saying, is that process reliant on a few people, or can that be duplicated across with relevant skills? And if it's reliant on a few people, then it's highly risky for me to give you my money, knowing that if you fall sick, tomorrow the business is not going to be available, or it's not going to be able to be operational. So those are some of the few considerations I think starting afresh would be sitting back and saying, I need 4 people. How do I get 4 people into the business? If it means setting up a employee share structure because I can't afford to pay them now, let's do that. But let's set up how our business operates on a day-to-day basis so that it's something that is duplicatable across the board. And when an investor comes in, they get to see that, because one of the few things we do in due diligence is just observe how your business operates. And one, you can tell that through numbers, but you want to be able to say that if XYZ happens, which what we do is we do stress testing. If XYZ happens, who responds to that? And once we see gaps, that then informs on whether the business has a strong foundation operationally, or they don't.
Thank you very much for those responses, Prince. I see in Ndando Yongosi has asked a question here. I'm just going to try and read it out, but I also see that you're currently typing another question. You mentioned that one needs to raise 20 to 30% of the total capital required. How do we justify that to the use of proceeds? Question mark, contingencies, question mark. You mentioned that one needs to raise 20 to 30% of the total capital required. Justified in terms of the use of proceeds. What does that mean? And please try and respond. Thanks, Prince.
So the biggest challenge we have, right, is somebody asks for 10 Rand, and then for whatever reason, they require an additional 2 Rand. Now, they did not clearly plan for any form of issues to happen, primarily because they just went in and said, I have a code and the code is X amount of money. Now, once you then start engaging on that, the suppliers come back and say, well, yeah, that is for the good, but you now need to pay for transportation and you need to pay for X, 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 X. So what we normally then say is to say, if you need 10, rather get 15, and the 5 is your contingency as outlined. Because what the 5 helps you do is to say, if anything was to happen and you needed funding, you don't have to now go redo a new application. So you are able to then sit back and say, I think I learned this more when we were building our restaurant, which is you can have you can have a bill of quantities required up until you are actively on the ground building. There's going to be a multitude of other costs that just creep up that ideally help you build and improve your business better, and you want to be able to then raise towards that. I think even when it just goes into building tech products, you can sit back and have a cost structure that is going to be 25 hours. This is how much I'm going to pay the people. This is the licenses that I need. But up until you start building that particular product, you then start realizing what are the other dependencies that fundamentally increase the cost of that very same product. So usually when you then do raise, the sentiment becomes add a little bit more fat in case anything shifts on either way or either side, so that it allows you to also then not run out of money and then being stuck. I'm sure people have seen houses being built, and then all of a sudden they stop building. So that the people did run out of money, but had they slightly added a little bit of a contingency buffer, they would have been able to fundamentally finish all the particular construction required.
Okay, for that response. I think Ndando Yengos is still typing another question. The question is, thank you. Do you know any capital funders locally? What sectors are they most interested in?
I do know a lot of venture capital firms, and to be honest, it depends. I think everybody knows Knife Capital. They are heavily centered around tech. I think Savant also is heavily centered around tech. But you've got agencies like your Aeons who are then looking at your agribusinesses. You've got I think Ellen Gray Hobbs. I just forgot what their company name is actually called. Ellen Gray Alternative Investments. They then look at across the board for businesses, but they usually have to either have had a Ellen Gray Fellow as a member, but you can go also raise capital through them. And then I think some of the banks usually have alternative investment segments within the institutions that also kind of allow you to be able to then access financing across the board. I hope that.
Okay. I think that was a great answer. I think what we'll also do along the SME Access to Finance series as a JCCI YC, that will have a specific venture capital event just to discuss that. But holistically, I think this was a very rich discussion that we've had in terms of the content, the knowledge, and the information. I must say I also was able to learn quite a lot, and I hope our audience and guests also picked up quite a few pieces of information. I think if they want and they have a funding application, they can challenge them to you to send solutions so that they can further investigate and look into the funding needs that they have in particular. But holistically, we want to say thank you very, very much, sir, for this presentation, for what you discussed, for taking the time to just enrich us with the in-depth level of knowledge and experience in both business and in funding. It's been a very exciting evening. It's been quite a lot that we've learned. So we're very, very grateful. And thank you very much. I'm just going to give a second to anyone else who wants to raise their hand and perhaps ask a question.
Okay. Yeah, Prince, thank you so
Move over
much.
to our chair lady who will do the closing for the evening.
Yeah, so I'll hand over to Nonjabulo, but thank you so much,
NJ?
Prince. Yes, I'm going to hand over to NJ.
My pleasure.
Thank you so much, Prince. This was such an informative session. I think some of the mistakes you mentioned that we make as SMEs, unfortunately, when it comes to access to finances, we tend to sometimes take lightly the importance of compliance. And the statistics that you were sharing are shocking, and unfortunately, we only have ourselves to blame as SMEs. So this was very eye-opening, and I think one of the things that we'd want to actually highlight on my end, which was very true, is the fact that understanding the type of finance that you need for your business, and if that finance for that business is at the right time for that business, because like you were saying, that, you know, sometimes debt is seen as a bad thing, but people don't understand the impact of losing equity and a percentage of your business when you actually go the equity route in terms of raising funds. So I think we all got an opportunity to learn a lot. We want to thank you for your time, and we really look forward to engaging you further in terms of learning from you, especially when it comes to assisting us as SMEs to see how we can actually access the funds that we need to be able to better our business. Thank you very much, and all the best when it comes to 2 Cents Solutions. And before I close off, I think the one thing that I wanted to ask that you maybe did not touch on, you just did actually give a overview in terms of the funding, the different funds that you currently offer within 2 Cents Solutions. Is there a manner in which the SMEs that are online that can be able to actually have a look at how they can actually access those type of funds?
Yes, so you can definitely go to our website, which is www.2centsolutions.co.za. Alternatively, you can send an email out to either info@2centsolutions.co.za or applications@2centsolutions.co.za. Like I said, I think we've got an application form on the website, but it also just outlines all the particular programs that we are currently undergoing. For programs such as the Oribi partnership one, which is a blended finance solution, usually those run through the Oribi channel because they are an NGO and they do some form of training if you're in the agri space or the agro food processing space. However, all the other ones, usually you just go into the website, apply, upload documentation, or you can inquire by sending an email, and then one of our analysts will be able to then engage and then take that application through.
All right. No, thank you so much for that. I think one more question, I think that this also just sparked my interest. I don't think I've actually come across a funding house that actually has a fund for youth multimedia fund. Can you just give us a bit of insight on that? I mean, I remember when I was going to varsity, when people would say that they're in the humanities field or in the arts, and you'd be like, oh, these guys are sitting under trees the whole day. You, as a finance student, you are busy stressing and people are just chilling. So this is quite interesting. Maybe if you can just give us a bit of insight in terms of what inspired, you know, this specific fund for the creatives.
I think all of our funds actually are built on the backbone of industry insights. So when we wake up one day and decide to finance spaza shops, it's one on the basis that we believe or we know that spaza shops are profitable, and they deserve to be financed. Then we just figure out how do we then make it in a creative way. When it comes to the multimedia fund, we've done a lot of short-term project financing for the space, which ideally takes creatives or enables creatives to be able to then execute on their ideas. You're looking at galleries or artists doing gallery shows. You're looking at somebody wanting to perform a theater program, and or you're looking at the rise of um, content creation, right, as a avenue for revenue generation. So how we looked at it from a design perspective was, with Netflix being one of the biggest players on the African soil from a content consumption perspective, and that allowing or potentially creating an avenue for people that are in the creative space to write scripts. Their biggest barrier then fundamentally becomes, how do I get access to capital to be able to then put these scripts into something tangible and selling those things to Netflix. And that's literally the thesis, to then say, how do we then allow and enable creatives, teach them the financing part so that they get to become creative, and ensure that, one, they've got access to equipment if they need to shoot, ensure that they've got access to machinery, and then model it aside with them to then say, this is how you're gonna shoot this production, you're gonna set up this um, um, what are these things where people do interviews, podcasts, and then how do we then commercialize those things? Once we figure out the commercialization structure of those things, the funding becomes a lot more easier, and we work closely with some of the key partners around distribution of those contents. We work closely with some of the value chain partners around access to the equipment, because getting a camera could potentially cost you 500,000 rands. How do we then come in and bridge that gap, allow you access to that, knowing that once you've shot the content, this is the next step is going to go to for commercialization, and then this is your waterfall of revenue. You're going to use advertisers on board. You're going to get sponsorships. This is how you're going to promote it or premiere it. These are the channels, the Joburg, I think the alternative channels for promotion, and then from there you are looking at either royalty engagement in those particular transactions, and or you get a commission structure through one of the other bigger channels, and then our investment helps the entrepreneur or the artist to be able to bring birth to a script, get it shot, and then being able to set it to commission structures.
Okay, thank you, Prince, for clarifying that. So I can scratch off being a rapper on my list. I thought I was just going to come to you to get some money and just launch my career, but clearly I'm mistaken. But no, this is
I think
amazing.
there is an avenue there, really, because remember, you're looking at the full value chain. So
Yes.
for if you are saying you want to be a rapper or a
Yeah.
musician, the conversation becomes about scoring, right? So we then sit back and say, how do we help you build a studio? I mean, we do gaming. We worked with Sony's. So we buy computers, allow young people to learn how to code. When you're looking at ads like Mashabela or Noko, for instance, those are some of the animation investments that we do. So even in rapping, there's when you're looking at a movie, there's always music behind. So how do we build you that studio that allows you to do that essentially? Maybe not necessarily to compete with AKA or Casper, but more on a commercial basis to then say, when you look at the entire creative space, how do we help you as a creative own a piece of the value chain or own a piece of the industry, and ensure that your art can be commercialized in the right way. But if you do want to be a rapper, we have other businesses that can ideally help you get there.
All right, so it's keeping the dream alive. Okay, no, thank you, Prince. I think before I just close off, there's another question here by Ndandowe Nkosi, and it says, "Would 2 cents be interested in a agro processing facility in Eswatini or listed manufacturing entity in Eswatini?" So I think predominantly maybe the question around is your financing, of course, does it go across borders, or is it just based on businesses that are locally in South Africa?
Thank you very much for the question. We are definitely I think we are officially a Pan-African entity. So we go across the borders. So Eswatini, I mean, technically South Africa, so there isn't much of a difference in that regard. So we would definitely be interested, one, in understanding what the facility has. We've done, I think, multiple transactions across with Eswatini, but also multiple other transactions across borders, i.e., your Angolas, your Kenyas, and the likes.
Thank you, Prince. Zwelethu, I'll hand over to you. I saw your hand up.
Yeah, I can also assist with the agro processing facility in Eswatini if that's a requirement. The person, I think it's Ndando Ngosi, can just also drop me an email if they're stuck with something in that regard, and then we can see how we can assist. Thank you very much.
Awesome. I think I see Kagiso Mandisa Anele Mabaso typing. Guys, because we have actually given you the ability to be able to actually raise your hand and unmute yourself. Maybe let's do that instead of using the chat. We still got a bit of time, so you can just raise your hand and then we'll give you the floor. I am monitoring in terms of the order. So you can just raise your hand and then we'll give you the opportunity to then speak. So Anele, we'll start with Ace. Anele, you can unmute yourself and then you can ask your question.
Good evening, everyone. I would like to know, in terms of a cosmetic business, a brand for hair care products, what type of financing would I be able to apply for?
You are manufacturing or you are buying hair products?
I am manufacturing.
How long have you been operating for?
It's still a bit new, so I would like to know a way going forward.
I would recommend angel investment within the manufacturing space. Ideally, I would say also look into grant financing opportunities where you are looked at as a manufacturing business that combines chemicals and then converts them into cosmetics. That becomes easier up until you've built your business case, you've built a client base, and then from there, once you have more sales, then you can then consider debt.
Oh, okay. Thank you so much.
Mr. Dlamini.
Okay, no, oh, sorry, Zwele, too. I just wanted to say, I'm in agreement, there, Prince, regarding the grant funding. I think that's one of the mistakes sometimes we make as SMMEs, that we don't actually take advantage of all of these opportunities. I mean, there's the likes of NYDA, I think SETFA also, they have various grants. There's also ESD programs that we can try and take advantage of, specifically when you are starting up as a business. Then it does kind of give you a bit of an allowance, because, I mean, when we come to you and 2 cent solutions, then, I mean, at the end of the day, you want your money back. So if we still need to try and actually proof of concept kind of thing, as a beginning business, then the grant is always the way. So to please go ahead. Apologies.
Hi, good evening. Thank you very much. Just to discuss the cosmetics business, I think one of the first steps holistically is to make sure that you have the proper sort of business plan and documentation in place to lodge an application with the South African Development Finance institutions, some that NJ has mentioned. The DTIC also has a personal care and cosmetics fund that's available. There's also the Department of Small Business, which is a government department that funds small businesses in South Africa, women owned. There's also SEDFA, as mentioned, and there's also the NYNDA, sorry, that also then does grant funding and small SME funding to start up in the cosmetic spaces. So I think what's strategic is to first start with the holistic business plan, a financial model, put your governance documents together in terms of company ownership structure, then make sure that you have supply, make sure that you have a proof of concept in terms of the actual cosmetic product. So you want to make a prototype first. You want to try and sell those prototypes. And then, as Cheledi mentioned, you also want to try and get into the clicks, the Pick and Pay, the Woolworths, the ESD programs where they do enterprise supplier development by allowing you to start by funding the development of your products, but also trying to get some of your products sold and then on the shelf as well. So holistically, you want to develop the brand, develop the product, and then go for government agency funding. Thank you very much.
Thank you, Zwele, too. No, thank you very much, everyone, for taking the time. Prince, once again, thank you so much for gracing us with your presence and sharing your knowledge, your expertise. We've learned a lot, and I do want to believe that we're able to actually learn something today and grow as individuals. I mean, I personally have learned, even though I'm a finance person, but I've learned a lot also being able to actually join this engagement and have the opportunity to engage with you and learn from you in terms of your expertise. Thank you very much. And please enjoy the rest of the evening, everyone. Goodbye.
Bye, everyone.